Hey, welcome back to Family Investment. Week number 8, so much to share, especially on the macro. I've got one major concern sharing with you all today, and this, not sure which direction we'll go, but we need to be defensive, we need to be precautious. So let's jump straight in. Okay, week 8, macro. And this is where I want to showcase, okay? Let's get some energy on this one here, okay? So, Moody is the seasoned AAA corporate bond yield. It is the most high quality bonds put together on US market to understand where we are. So at the moment, we're standing at 5.36. Okay, we're creeping up again. The last time we went there was towards the end of 2023. It was creep up in 2022, came back down, and we're back up again because of inflation. The bond yield is going up. Is that a concern? Of course. Remember back in 2020, and we had, the COVID came down, and then Tom Lee came out and said, buy everything that you can. Why did he say it? Why is he so confident? Because the bond yield was as low as 2%. It was so low in the last 40 years. And he said, buy. That's where it comes from. So if I bring you another picture, this is the last 100 years. And the last 40 years since the 1980, that major crash there. For 40 years, the bond yield has been slowly coming down. Okay, slowly coming down. It bottomed during COVID, and then it's starting to creep up. Folks were saying, oh, maybe it's going to come back down again, but for some reason, it looks like it's stabilizing. When it's stabilizing, it seems that it could go maybe 5% and higher. We don't know. And what made it even more compelling is the gold is hitting all-time high. Every time we hear about the stocks market going all-time high, gold decides to go all-time high as well. So where you need to come from is bond yield all-time high, gold all-time high, and stocks all-time high. That's not normal. Bond yield goes up, stocks come down. Why? Let me show you. So as you can see, the last 40 years, bond yield has come down. And at the same time, the last 40 years, the stock market has gone up. Why is that the case? Of course, there's a formula to this, okay? It's like E equals MC squared, Y equals MX plus C. There is a formula to this. This is Graham's formula. Further developed in 1965. Most of us still use it today as a very quick check, the pulse check, okay? So you've got the valuation of a share price, the intrinsic value, the base case value of a share price. It could be Costco, it could be Tesla, basic share value. It works not on every single stock, but it works as a blanket, and capturing, as a shell to check, okay? EPS, you got 8.5, which is growth stock stops at 8.5. Your P ratio of a stock is 8.5. That means the growth is stagnant. 2 times the growth, and then 4.4, which comes. But why I'm trying to come from is this Y here. This Y is the current yield on a 20-year corporate bonds. Yes, the Moody. So remember your maths back in school. If the valuation goes up, this thing will come down. Okay. If that thing goes up, if that yield goes up higher, your valuation comes down. Yes. So if this starts to creep up, that means the valuation of your stocks that you own, technically, the base case, the price of your house should be coming down. Because folks should be rotating money out into the bond because it's safer, zero risk. That is where it comes from. There's a bit of an offset between share price and bond yield. If they go up at the same time, it's very, very concerning. Okay, so this is why I am saying that macro, I'm watching. I'm getting a bit concerned. We cannot have everything at the same time. It's just a precautionary textbook case that we're dealing with here. But then if, going even deeper, Japan seems like they're on the only place that's increasing interest rates, GDP is rising. They're on like a different planet, okay? Because they've been low the whole time, That's right. Even the professor came out and saying, okay, Japan beating numbers top line, considerations to be noted. So Japan is on a whole different base case. But where we're coming from is Germany. Germany is on a technical recession. Bond yields coming up. The war should be stopping soon, but the defense spending is going up. So things are going very non-textbook case just now. This is why I think we need to start thinking out of the box. And even with the tariff, now the next tariff should be hitting on Taiwan. That's why you see lots of TSMC moving to America, trying to merge with Intel on the fabrication yard, and lots of things are happening trying to protect themselves, trying to protect their GDP growth. Okay, so going forward for me and the club, okay, and the BuyTrigger, my brand, is I'm going 2.0. Okay, when I say 2.0, at the moment, the database I shared, the BuyTrigger shared, is at 1.6. It's a snapshot at a static in time. But because of the ongoing changes, I'm implementing upgrades to the database, doing all on my own, use my engineering skills and the tools that I have, the mathematical ability that I have to try to build a dynamic database, and hopefully this will help us stay ahead of the game. You know, we all can't afford Bloomberg terminals, but with simple tools that we have today, that we have given, we can start building them with our own hands. We don't expect experts. I don't have a degree or an MBA in engineering, financial, or maths, but I do have the ability to try to make something out of my engineering ability and my neck. Okay, so going forward, hope to share, and this is a super short version for you BuyTrigger Club members. There'll be a longer version of this video explanation in the club website, so do check it out, a longer version of this video, and also the details of the 2.0 that I'm going to. So thank you very much to all of you who follow and share. If you're interested, come and join us in the BuyTrigger Club to learn more, to get ahead of the game. But otherwise, newsletter is free on a Monday, so hopefully you can sign up and for me to share whatever news that I have honestly and directly into your inbox. So guys, thank you very much and hope to see you soon.